All right, simple interest. So now we know what interest is. Interest, which includes premiums like inflation, default rate, maturity, and the opportunity cost of capital. Great. And the reason I took my time there explaining the interest was so it makes understanding the rest of the concepts easier. Now, interest is either simple or compound. A simple interest is the cost to the borrower or the rate of return to the lender, depending on how you look at it, per period on the original principal. And you should know that conventionally, interest rates are stated as annual rates. So, the period is assumed to be 1 year. Now, the cost or return, again, depending on how you look at it, is stated as a percentage of the original principal. For example, a loan with a 5% interest rate, it means 5% of the original principal per year. Or a bank that offers a simple interest rate of 10%, same thing. Now, the actual amount of interest earned or paid depends on the interest rate, principal, and the number of periods. And if you were to show this mathematically, it will be simple interest equals the interest rate multiplied by the principal and again multiplied by the number of periods. Simple interest, simple calculation, right? Now, although it's a simple process, let's do one example. Let's say you put your money in a bank account and the bank offers you, let's say, a 10% interest rate. So the simple interest rate would be 10%. So for every $100 that you put in the bank account, your principal, let's say it's $100. And let's say you want to find out what will happen, how much in interest you will earn after number of periods, let's say 2 years. All right. So that means 10% of the $100, $10 multiplied by 2, $20 in simple interest after 2 years. Let's see what it looks like on a timeline. So t equals 0, that means today. So you put in $100 today. And the simple interest rate, we call that R, equals to 10%. So after the course of 1 year, 10% of your original principal, $10. And then again for the second year, again the R is still 10%. And your original principal also hasn't changed. So 10% of $100, again another $10. So $20 in interest plus your original $100, that will make it $120 in total, right? So that will be the interest plus your original principal. Now, one thing I'm pretty sure you've already noticed is that we're not adding this $10 that you're earning in interest to your original and then recalculating it for the second year. And that means that simple interest is not reinvested and is applied only to the original principal. So if you go like 10 years also, still the simple interest rate that you earn if your original principal hasn't changed, you also get that 10%, that $10. So 10 years, still per year $10 because it is calculated based on your original principal. And we will see with the compound interest what a big difference it can make if it's reinvested. We will talk about compound interest next. Now here, as you can see, we came up with the the future value of $120, $20 of interest plus your $100 of the original principal. So if you were to write out a formula that would come up with this number, interest plus your original principal, this would be the formula. The future value would equal original principal multiplied by 1 plus simple interest rate multiplied by the number of periods. So that means, in this case, your original principal, let's go with this one, still $100 multiplied by 1 plus the simple interest rate, 0.10, which is 10%, multiplied by the number of periods. Let's calculate this time for 3 years. 3, right? Okay, so this becomes 0.30. The whole thing becomes 1.30, 1 plus 0.30 multiplied by $100. That will give me $130 in total, right? $30 of the simple interest, $100 my original principal after 3 years. Okay, great. Now, if you were to, because this is the whole, every time you were to write the whole thing, that would be slightly difficult. So we would abbreviate these names. So for future value, we would just write, FV. For original principal, because that's your present value, we call that PV, and multiplied by 1 plus the simple interest rate, we call that R, multiplied by number of periods, we call that N. So this is how we would write out the formula from now on, instead of writing the whole thing. Okay, let's talk about compound interest. Now, with the compound interest, if you truly understand the power of compound interest, your life will never be the same. So, compound interest is often referred to as interest on interest. As opposed to simple interest, interest is assumed to be reinvested. So, future interest is earned on principal and reinvested interest, not just on the original principal. In other words, your original principal changes every period that it is compounded. Now, to understand what I'm talking about better, let me rewrite the example that we did in the previous slide, so we can compare simple and compound interest. Now, if you can recall, we started with a $100 deposit, and the interest rate was 10%, right? So, with the simple interest rate, 10% of our original deposit, $10 of interest, and it doesn't matter how many years we go, it's still going to be $10 because it is calculated based off of the original investment, right? So after 3 years, $30 of interest plus the $100 of the original investment, $130 in total. Okay, great. Now let's compare it to compound interest. In the case of compound interest, let's go with the same deposit. Let's say we deposited $100, the same interest rate, 10%. All right. Now, after the first year, no difference. The same thing. The 10%, just like the simple interest, will be calculated based off of the original investment. So we'll end up with the $10 interest, right? Now, this is where it gets interesting after the first year. Here, again, still we have the 10% interest. But in the case of simple interest, we were using the interest and we were calculating it based off the original investment. But here, our original investment is changing. This $10 in interest will be added to the original investment. That means $10 plus $100, 110. So this 10% this time will be calculated based off of this, not this. That means we end up with $11. So as you can see, there is a dollar difference between these two. And I know this difference may not look very impressive, but over a longer time period, the difference becomes bigger and bigger. So let's continue this. All right. So the next year also 10%, still the rate hasn't changed. Now this $11 has to be added to 110, right? So plus 110. we will end up with $121. Now this 10% will be calculated based off of this. Again, not this, like the simple interest. So 10% of 121, that will be $12.10. Now, as you can see, the differences keep growing. So let's compare the total. Here we have $33.10 plus our original 100. We'll end up with $133.10. So overall, $3.10 difference. Again, we are working with a very small number, just $100. And we are doing that over only 3 years. Imagine a bigger number, longer time period. This difference will become noticeable. Until one day, the interest will be even more than the original investment. And we will do a few examples for you to understand the difference. Let's say over 20 years, but drawing timelines for 20 years, that's going to be ridiculous. So we're going to use the formula. And this is the formula to come up with the future value in the case of compound interest. Future value equals original principal multiplied by 1 plus simple interest rate to the power of number of periods. Now this is the big difference. We are using exponent. This is what compounding is all about. When we were using the formula to calculate the future value for simple interest, no power term. Here, in the case of compound interest, we have the power term. So let's use our formula and calculate what will happen to our money after, let's say, 20 years. Okay, so our original principal, let's go with this, 100 multiplied by 1 plus simple interest rate, 10%, 0.10 decimal way. Number of periods, we wanted to calculate for 20 years, so the power term will be 20. That would equal $673. Now, just to show you the difference, let's see what number we come up with if we use the simple interest. So in the case of simple interest, that will be 100, the original investment, multiplied by 1 plus 0.10 multiplied by the number of periods, 20 years, right? And that will equal to $300. So compound interest, $673. Simple interest, $300. Okay, great. Now in the case of compound interest, so far we were calculating it, on a yearly basis, annually. Now in the next slide, we will talk about other frequencies, like quarterly, monthly, or even daily.